Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Rideout Shear Zone in Ontario, with grab samples running as high as 32 grams per ton gold. A follow-up drill program to test numerous targets located by recent groundwork is planned for early 2018. Please visit our website at rmroyalty.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Rick Ackerman, editor of the newsletter Rick's Picks, his website rickackerman.com. Welcome back to the show, Rick.
Always a pleasure, Jim.
And where are you speaking to us from this time?
Well, I'm speaking from sunny South Florida.
Yes. Well, it's sunny and hot here in Vancouver, so for a while at least we're not jealous.
Well, that's good to hear. Sometimes we all wish we were living where the people we talk to on the phone are living. You know, it's too hot down here. I'd love to be in Vancouver, but anyway, glad to hear you having weather you're enjoying.
Well, we're in the 80s and 90s here, so it's warm. Rick, speaking of things that have heated up, interest rates, are they still going to continue to rise?
Yeah, it looks that way, Jim. I know going back a ways in our discussion, I had a very good call on the 10-year back in December of 2016 with rates on the 10-year at 2.34%. I was projecting a rally to 3.11%. I hit a dead bullseye on that, dead center. And we've come down since to a low of, I think it was 2.34%. So that was a considerable sell-off. But it looks like rates are rising again, and they're headed on the 10-year above this 3.11 top that occurred months ago. And my next target on the 10-year would be, I think it could go as high as 3.74% on this move, which even now we're seeing these rates impact on mortgages and car lease rates and things like that that are crucial to the economy. So I don't have to tell you that even a small turn of the screw with 10 years 3.25% or higher is really going to start hitting the economy.
Do you feel that there's a point where the housing market is just going to take a huge blow to the face if we hit a certain interest rate?
Well, we've already gone through the stage where the home builder stocks have collapsed, and they've even kind of rallied back a little bit. But the full-blown disaster in housing is a deflation of home prices, and I think that's where we're headed eventually. It's something that I've been looking for the last 20 years, and my forecast going back all those years was for a 70% collapse in real estate prices, approaching more like 90% for the vacation home, the second home market. So we got halfway there in the collapse of 2007, 2008. But I think the other shoe's going to drop. And of course, real estate is just as pumped now as it was in 2006.
If that happens, what does that do to the economy?
Well, it's interesting. You know, we think of mortgage rates when they get down in the 3% area as being pretty low, and historically they are. But you need to measure that in real terms, you know. And if your homes are deflating by 10% or more per year, as we saw during that the great financial crash of 2007 and 8, then a 3% mortgage becomes a crushing burden. So I think that's where we're headed, really. The rates are already high enough to completely choke off the first-time home buyer. There's no market there. You know, the demand would be coming from millennials who, as it happens, are living with their parents till they're 30 years old. So from an economic standpoint, you know, all the activity really begins with housing construction, and certainly these auto leases are a big factor. So the higher rates are going to sort of kill the economy where it's in real terms, it's still going.
Do you think economists and politicians forget how important real estate is to keep things moving? How many jobs are involved? Electricians, carpenters, landscapers, people like that.
Yeah, it's definitely it's more than ripples. I mean, the economy is the housing economy is really what moves the U.S. And of course, every new house that's bought or constructed, you've got to fill it with refrigerators, stoves, and everything else. That's just not happening to the degree that it would in a truly robust economy.
Yeah, I mean, I can attest to that. I've just moved into a new home, new fridge, new dishwasher, new microwave, new everything.
Yeah, it's and I refinished the Florida home that I'm living in now. Same thing, you go to Best Buy, you buy a lot of big ticket items, but we're just not seeing that activity. We're seeing a lot of percolating in 5 stocks that account for so much of the gains in the S&P 500. But they're just glorified advertising agencies. You look at Facebook and Google, and that's primarily what they do. They have advertising revenues that used to be distributed among 20 large firms around the world. Now just a couple of players capture the lion's share.
We'll have more with Rick Ackerman right after the break.
I'm Brian Fowler, president of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead zinc silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic engineer gold mine in the Atlan district of northwestern BC. Check us out at blindcreekresources.com.
Vatic Ventures Corp. is a potash exploration company focused on the Korat Basin in Thailand, the world's largest undeveloped potash resource. Vatic's management has extensive potash exploration and development experience in Thailand. Vatic will have marketing advantage compared to Western producers. Drill program commences this spring. Vatic trades on the TSX Venture, symbol VCV, and on Frankfurt, symbol V8V2. Visit our website, vaticventures.com.
Welcome back. We're speaking with Rick Ackerman. Rick, you talked about the Wall Street Journal and the wall of worry. What's the story there?
It's just amazing what this market is going up against through, I guess, force of habit and the fact that for all these chimpanzees who manage money, it's really a pretty easy decision. You just throw it all at Amazon, Google, Netflix, Apple, and Facebook, and that's it. It doesn't really take much genius. I did have a guy mention in my chat room that his son worked for some hedge fund or investment fund that had quite a bit of money, a $42 billion portfolio, I think it was, but it's so heavily invested in Amazon and Netflix that they've outperformed, the averages by 300%. So, as long as they only have to throw money at 5 stocks, it's pretty easy to make money. But you see a lot of artificial inflation in the markets, and this idea that the stock market's healthy. It's not. The leadership is so concentrated, and the capital is so narrowly channeled that I see no real health in the financial and investment side of things.
Is it really true just 5 stocks are supporting about 50% of the NASDAQ?
Yeah, I mean, and it obviously leaches into the S&P 500 when you get some of these cap-weighted stocks have their effect on the S&Ps. And that's why, the S&Ps from a strictly technical standpoint have done, they've done something that's bullish. They basically rallied above the secondary high in February. The market came crashing down in early in February, March, and the big rally left the top. We've gotten above that top with the S&Ps, but the Dow Industrials are still at least 500-600 points off that threshold. And it's because, the industrial average represents stodgy old America rather than these FANG stocks and glorified advertising agencies.
Would you think the record high rate of buybacks of stocks is a form of private enterprise quantitative easing, an artificial boost to the market?
It's a form of stupidity and desperation. These companies have huge surpluses of cash, and they don't know what to do with them. Heaven forbid they should give them out as in the form of dividends to shareholders, but a good piece of it, goes to the directors of the company, the people who run the companies, who get all the stock options. The companies buy their own shares back. It artificially inflates the earnings multiples. And of course, it allows these guys to cash in on all their bonuses. But it creates zero economic growth. And, even the Wall Street Journal, which is certainly one of the cheerleaders for the bull market, has raised the issue of whether these corporate buybacks have slowed down somewhat simply because the prices are so high. I mean, even for the companies themselves, they are apparently asking themselves more and more, well, should we be buying stock at these levels?
There was a time when corporate buybacks were illegal. Should they return to that?
I would say that's sort of anti-capitalism, you should have, but the problem is one of governance and oversight. The companies get away with these things because you don't have gadfly shareholders coming to the corporate meetings. It's like nobody cares, partly because there's so much money being made in the markets. It's like there's enough to go around. Everybody's pretty much satisfied. But when you see what happens when nobody's watching the store, you get, the corporate executives get hugely overpaid. They get enormous stock bonuses. Some of these guys make $10, $20, $30 million a year. They're paid like baseball players, and it shouldn't be, but it's like no one's watching.
We'll have more with Rick Ackerman right after this.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp. Inc., MGI on the TSX Venture Exchange. A 2015 drill program on the LH property intersected high-grade gold, including 16.9 meters of 13.58 grams and 11 meters of 20.66 grams per ton gold. A follow-up drill program is planned to further evaluate previously identified subsurface high-grade gold mineralization. Please visit our website at magnumgoldcorp.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're chatting with Rick Ackerman. Rick, tariff wars, are they working out for America?
Well, you can see on the front page that they're working out very badly. It's rarely that we see things for the horror they are. And here we've got Trump saying, hey, we need multi-billion-dollar subsidies for growers of certain crops that have been hit really hard by my tariffs. And it's true, the American heartland is in desperate shape. You cannot make money unless you're like mega farm anymore. The farms owned and operated by individuals are becoming rarer and rarer because it's just impossible to make money in it. So they've gotten hit really hard by these tariffs, and it's created a huge surplus of certain crops. And when the solution is so obvious, or when Trump puts it out there in a form of, well, we've got to give subsidies to all the growers, it's rare that the problem is so bluntly obvious that we can see who's paying for it. Like, okay, we'll subsidize the farmers. They could certainly use it, but who pays for that? So it really puts the tariffs front and center as a bad thing. It puts the cost right there in our faces.
Well, also, when America asks for help from its allies, what kind of allies are you going to have when they've all been slapped with super high tariffs on their products?
Well, that's true. I mean, we're going to have geopolitical tensions as a result of these tariffs, and it's not like we were getting along that well with Europe to begin with, but this is just more reason to be more hostile toward each other. But to come back to the economic concerns with tariffs, I could even argue the pro-tariff case and just say, well, it would be good to protect certain U.S. industries for a while so they could get back on their feet. The problem is that there's a really long lead time on that, and it only works to the extent that under a protectionist regime, these industries, like steel for one, put massive amounts of capital into new plant, new infrastructure. So that's a problem, really, because you can see that all of our massive capital is going into Google, Facebook, and Netflix. You know, we're a country we've lost interest really in investing in the mundane producers of actual things, and we prefer to put all our capital in garbage and fraud like these advertising agencies. So there's a real problem then with the benefits we would supposedly get from higher tariffs. And one other thing is that when you have this massive investment in, let's say, steel production, what that investment seeks is to produce steel with a smaller labor input. And so the more we invest, the more people we're going to displace from jobs. So anywhere you argue tariffs, they don't lead in a good direction.
Can the U.S. get back the customers that go elsewhere to find their products because of the tariffs? The Chinese, for example, I believe are using South America as their source of soybeans.
Not easily. You know, the tariffs are going to create major dislocations of that sort. And as countries like China source some of their needs from other suppliers, those suppliers are going to gear up. And in order for us to get that business back, we'd have to compete on price. And you can see there indirectly how tariffs bring us to certain deflationary pressures.
Yeah, it's because you'd think the South Americans with lower labor costs were able to produce those products cheaper.
And they will. They will find a way. Let me mention also the scariest story that I've seen in the journal relative to tariffs is a piece by Robert Samuelson, an economist, who says he puts global debt at something like $247 trillion. That's a quarter of a quadrillion. And with a reduction of trade flows and therefore a reduction of income to all these companies on their trade balances, we're going to have a rough time servicing the interest on that $247 trillion worth of debt. So there's no question that the tariff war that has been heating up is going to reduce global trade and therefore global incomes. And it is from those incomes that we pay the interest on global debt for all kinds of things, everything from, bonds that back up pension funds and things like that. The list goes on and on and on. So within the tariffs, higher tariffs contain, again, the seeds of a massive deflation when those $247 trillion worth of borrowing come home to roost.
Also, what happens to U.S. banks that have lent out that money? Will they see a lot of defaults?
Well, if I can say there's a nice thing about a deflationary collapse, it at least visits the pain on borrowers according to their sins. You know, if you're really deeply in debt during a deflation, then you're going to have to pay back what you owe in increasingly dear dollars. Most of the world's debt is denominated in dollars. So, going the other way, and there's still some lunatics out there who think we're going to somehow inflate away global debt or hyperinflate it away. Of course, that makes losers out of all the lenders because they're getting paid back in snide. It might as well be Confederate money. And the example I use for people who persist in thinking that there's a deflationary endgame here is the question: do you think that the mortgage holder on your house is going to let you skip out for a couple of hyperinflated bills that you peel out of your wallet? You know, in other words, if you've got a $300,000 mortgage and we've got hyperinflation, you're going to be carrying around in your billfold, millions and millions of dollars. And I somehow doubt that the mortgage lenders are going to say, yeah, we'll take payment in that worthless money. So that's why I've felt all along that the debts, which have become manifestly unpayable, will eventually settle out in liquidations, meaning a deflationary spiral.
Rick, thank you so much for chatting with us.
Thank you, Jim, for inviting me on.
My guest has been Rick Ackerman, editor of the newsletter Rick's Picks, his website, rickackerman.com. You're listening to HowStreet.com radio. Find us on Twitter at HowStreet. Our YouTube channel is Talk Digital Network. Questions for the show or our guests, like Rick, can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.